Hi and welcome to Swissquote's Daily Market Talk. It's Tuesday, August 12th. The US and China extended their tariff truce by 90 more days. Donald Trump said that gold will not be tariffed after all and confirmed that the US government will get a 15% cut of Nvidia and AMD's revenues from China. Now, all eyes are on the US inflation data due to be released later today and whether the new BLS chief of the United States will serve general or political interest. So no guys, this is not produced by Netflix series. This is real life. Opinions are my own and this is not financial advice. So Trump extended the tariff truce with China that was coming to an end today by 90 more days, said that gold will finally not be tariffed and confirmed that Nvidia and AMD will be paying the US government a 15% cut of their Chinese sales. Now, one emerging problem right now is that China doesn't want its companies to buy Nvidia's H20 chips anymore for national security reasons, because remember there was the news on the wire earlier this year that these chips would include location trackers, which sounded like they could be used as tools to spy on clients. So China may not want that to happen. Good news is that Nvidia could, under the new agreement with the US government, export a downgraded version of the well-known Blackwell chips to China until further notice. The bad news is that the Chinese government could, very well include these Blackwell chips or downgraded version of these Blackwell chips on this list of things that the Chinese companies shouldn't buy from the United States for national security reasons. So while things are getting complicated, Nvidia and AMD might have still improved their fortunes in China. Nvidia, for example, is expected to make more than around 20 billion US dollar in sales from China this year alone by accepting to share around $3 billion of it with the US government, if of course the Chinese companies continue to buy these products. On the US side, the fact that the chip export ban was motivated by the US own national security issues should give no guarantee whatsoever of business continuity in China, but nothing is guaranteed with the Donald Trump's government anyway. So consequently, Nvidia's share price retreated just 0.35% yesterday after flirting with the all-time high level, and AMD opened lower, swung to gains, but closed the day with a meager loss. In China, however, the market reaction this morning is a clear positive. SMIC, the leading Chinese chip maker, is up by more than 5% this morning on hope to see some Chinese demand diverted to the domestic brand from the US peers. Elsewhere, I was saying, or Donald Trump was saying, that gold imports will no longer be taxed. Ta-da! Yes, they will no longer be taxed because slapping tariffs on gold bars would have dramatic but very significant consequences for gold's international flows that mainly come to the United States from Canada, Mexico, and Switzerland. So these are the three countries that are less than happy with the US tariffs so far. So they will not be tariffed, these gold bars, because it hardly serves the US interests and risks to deviate gold from the country, which probably doesn't sound cool for the great America that Donald Trump is trying to build today. So as a result, gold prices are better a bit this Tuesday morning after yesterday's slump, also helping to boost appetite in gold, while Donald Trump hinted that his meeting with Russia later this week will be a feel-out meeting and that there will probably be no end to the Ukrainian war if Ukraine doesn't want to cede territory to Russia, and they probably will not be willing to do that. So it doesn't really smell good, and it was just too good or too much optimism to be true for what it was anyway. So crude oil also rebounds this morning. The barrel of US crude could easily return to and above the $65 per barrel level, which is a key Fibonacci level to this year's decline and which has also served as a strong support to the spring to summer rally that was backed by geopolitical tensions. Still in commodities, lithium made the headlines yesterday as the Chinese battery maker CATL couldn't renew a license with the Chinese government at a Chinese mine for at least 3 months. And that particular mine produces around 3% of the global lithium output. So the market's reaction was quite swift yesterday with a 5.5% jump in global Exel lithium and battery technology ETF. Now note that the decision could not be temporary because a part of the market reaction is due to the expectation that the Chinese decision not to renew permit to mine lithium is rather part of a broader capacity restriction amid a global glut in lithium actually pushed lithium prices 90% lower since 2022, along with slowing demand for EV batteries. So absorbing the supply glut in lithium could actually prop up prices and eventually help China fight deflation. And there is, room for an upside correction in lithium prices, considering that the global ex-lithium and batteries ETF, for example, lost up to 2/3 of its value since its 2022 peak and has recovered just around a fifth of what it has lost since the March dip. On the other side of the trade, Fidelity's clean energy ETF lost 1.65% yesterday as higher lithium costs will weigh on margins of the companies that are included in this ETF. Now zooming out, appetite in major US indices remained limited at yesterday's trading session, with the S&P 500 index failing to maintain gains ahead of today's all-important CPI data release from the United States that is expected to start showing the impact of US tariffs on US consumer prices, as many companies in the United States are thought to have started to reflect the tariff costs on their end prices. Yet note that the slowing services inflation in the United States could continue to counterweight the goods inflation or a part of it, but to what extent and how long, we will see today. So today, the monthly headline CPI figure from the United States is expected to have surged the most this year, and both headline and core CPI figures from the United States are expected to have ticked higher on a yearly basis in the month of July. The core inflation metric that actually matters more for the Federal Reserve expectations and Federal Reserve decisions is expected to return to the 3% mark. So that's farther away from the Fed's 2% policy target. So the thinking goes, a higher than expected CPI read from the US today should lead to the scaling back of rate cut expectations for the Fed for the September meeting and push the US 2-year yield and the US dollar higher and weigh on equity valuations, while a set of softer than expected CPI figures from the US today should back the Fed dose and pressure the US 2-year yield lower along with the US dollar and support equity valuations, on assumption that the economic data is thought to be accurate enough after the BLS drama earlier this month that led to the firing of the BLS chief. Now the BLS has a new chief, mind you, and all eyes will be on how well he'll be performing and whether the economic data from the United States will or will not be tweaked to serve White House political ambitions and soothe Donald Trump's economic worries. But one thing is quite sure right now, small and medium-sized companies of the US need lower rates to weather the trade chaos. The S&P 500's equal weighted index has also fallen significantly behind as market cap technology heavy version, suggesting that the post-April rally is mostly shouldered by the US big technology companies yet again, and that the market breadth has been narrowing, increasing the risk and the size of a potential market correction in the coming months. So any lack of evidence that tariffs hit US consumer prices would be more than welcome by Federal Reserve those and investors of stocks excluding technology. So this is all for today. I'm İpek Özkardeşkaya and thank you for joining me and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.